into ProSeries, and then review the results on the tax forms and the worksheets.
Hi, Mike. This is Amy. I just want to let you know that if you did not get the webinar guide in an email I had sent earlier or in the reminder, I went ahead and placed that in chat too, if that makes it a little bit easier to follow along. Apologies.
Please follow our new training forums for the latest updates, or you can click on the Resources tab to access these links and a PDF of today's presentation. So by popular demand, after attending the original training that we had for ACA, which was more theoretical, we did have some demos. A lot of folks asked us to offer a webinar with use cases as well. So here's a list of the various ACA use cases that I'll cover today. We'll go through some basic penalty scenarios, an advanced penalty scenario, some basic premium tax credit scenarios, an advanced credit scenario, and I'll show you how to do the shared policy allocation associated with the premium tax credit. Finish up with some exemption scenarios, marketplace granted exemptions, income below the filing threshold, and lastly, exemptions claimed on the tax return. So first off, we have use case number one. It's going to be a basic penalty scenario taken from IRS publication 5187. And I'll give you the facts, but then we'll go through the results in the product. We have Jim, who is an unmarried adult with no dependents, did not have minimum essential coverage for any month during 2014, and does not qualify for coverage exemptions. For 2014, Jim's household income was $40,000, and his filing threshold was $10,150.
Hi, Mike. This is Amy. I'm going to go ahead and have you just pause for a minute. With a hand raise, could everybody let me know if they can see the slide progression? We should be on case number 1, basic penalty scenario, IRS publication 51, with Jim, 2014 household income of $40,000. Okay. All right. It looks like we have just kind of an individual issue, so I'll go ahead and resolve that. You could go ahead and continue, Mike. Thanks.
Okay. Okay, now I'll go out to ProSeries where I have this client set up, and we'll pull up case number 1 here. And I'm not going to point out any ACA detail here because obviously the gentleman in the case did not have any coverage. So we're going to go directly over to the penalty worksheet. And that's going to be a subset or a worksheet within the Form 8965. And if you look in the Form 8965 instructions, government instructions, they have a worksheet on how to compute the penalty. So what we're showing here is that Jim did not have coverage, and the IRS instructions tell you to put an X in each month where there is no minimum essential coverage. Then we get down to the actual shared responsibility payment worksheet. And put that over there. So on line 1, number of X's for a month, and we have 1 throughout the year. Same thing on line 2, that's for folks in the household over 18. The grand total is 1 for line 4 as well. Then we're going to multiply each month by $95. Line 6, I'll address in a little bit. They want you to sum up the number of X's on line 1 above for the year. That's a 12. Then we get into household income. For this client, we have $40,000, filing threshold $10,150. That nets out to be $29,850. We're going to multiply that by 1%. and we come up with $299. Line 11 says, is line 10 more than $285? And the answer is yes. So we're going to multiply 10 by the number of months which line 1 is more than 0, and we come up with 3,588. And you say, well, why are they doing that? The IRS, it's a little tricky here. They gross up the number of the actual penalty. The penalty is the greater of the flat dollar amount or 1% of household income over the threshold. But what they do is they first gross it up for the number of months that there's no coverage or exemptions, and then on line 12 they divide by 12. So then we return back to the $299 figure. Line 13 is the national average premium for a bronze level plan, and that provides an upper limit or a cap on what we have to pay back to the government. And what they do is they automate it for you. They take the number on line 6 and they multiply it by $204 right out of the instructions. And we have a big cap here. It's $2,448, and we're well underneath that. So the penalty for the year is going to be $299. If we go out to the 1040, we'll see that the penalty then flows into line 61. So that's our penalty. Kind of a straightforward example, but we will progress to some more difficult use cases here. Okay, use case number 2, another basic penalty scenario, also from Pub 5187, which I've modified. We have Eduardo and Julia, married and have 2 children under 18. They did not have minimum essential coverage for any family member for any month during 2014, and no one in the family qualifies for a coverage exemption. For 2014, their household income was $45,000, and their filing threshold is $20,300. So you can refer to these slides after to look at the rest of the text there that goes through the results, but I'm going to actually review it in product. So we go back out to ProSeries. We're going to go to home base. And we're going to go to case number 2. And again, I don't have any entries in here since there were no coverage and no exemptions, so we'll go right to the worksheet. And that's going to be within the 8965. Scan down here, scroll down, and we have 4 members in the household. Nobody had coverage or exemption, so we have X's across the board. Line 1. Going to be a total of 4. Line 2, we have 2 adults over 18, so each month is going to get a 2. And then we have 2 folks under 18. They want us to cut that in half, so we put a 1. That's because the penalty is 1/2 if you're under 18. Instead of flat dollar of $95, it is half that amount, $47.50. So we have a 1 on line 3 across the board. We total it up, and we have 3s across the board. Multiply that by 95, and we have a flat dollar amount of $285 across the board. Line 6 gets a 48. Line 7, household income $45,000, less the threshold $20,300, nets out to be $24,700. Multiply that by 1%, and we have $247. Is line 10 more than $285? The answer is no. Enter the amount of line 14 from the flat dollar amount worksheet. So we have to go to the secondary worksheet here, and that's what we do here is we determine the greater of the flat dollar amount or 1% of household income minus the threshold. We do that on a monthly basis. That's why we go to this sub worksheet here. And in this particular case, the flat dollar amount, $285 per month, is greater than what the 1% of household income minus the threshold would have been. So we have $285 for each month. We add them up, and we get $34.20. And we bring that back up to the main worksheet here and punch it in on line 11. Again, what they're doing is they're grossing up the penalty for each month that there was no coverage or exemptions, and then we divide by 12. So we get $34.20 divided by 12 on line 12, and we're left with the $285. It's going to be underneath the cap for the national average for a bronze plan, and so our grand total penalty is the $285. We go over to the 1040, and we'll see that it comes in on line 61. $285. So in this example, it flip-flopped. In the prior example, it was 1% household income was greater. In this one, the flat dollar amount was greater. And we will continue to build on that. So we have here use case number 3, advanced penalty scenario from the regulations, and I have modified it just to show a more thorough use case. So in 2014, taxpayers H and J are married, file a joint return. They have 3 children, K 21, L age 15, and M age 10. H and J's household income $47,750. H and J's applicable filing threshold $20,300. H and J have minimum essential coverage for January through June. No other member of the family has minimum essential coverage for any month in 2014. Go back to home base here, and we will pull up case number 3. And since there was some coverage in this scenario, I'll point out what those entries look like. We're saying that households got a 1095B. What did it have on it? What we said in the example was Harry and Jane each have coverage January through June. So we click those boxes. No other coverage for the other members throughout the year. So then we go over to, we can go up here and just click on the quick zoom link to the 8965. Going to go down to that same grid for the worksheet, and we're going to see that there was coverage for Harry and Jane, January through June, and then X's indicating no coverage or exemptions for anybody else for the rest of the year. And we go down to the actual payment worksheet. Line 1, we're going to have 3s for the first half of the year and then 5 for the rest of the year, because Harry and Jane did not have, they did have coverage for the first half of the year. For folks over 18, one of the dependents was over 18, so that's going to have a 1 for the first half of the year, and then we add in the adults, and we have 3s for the rest of the year. 2 of the children were under 18, and they didn't have coverage, so we cut that number 2 in half, and we have 1s for the whole year. Grand total, we're going to have 2s for the first half of the year, and then 4s after that. Multiply it by 95, flat dollar amount with a cap of 285. We're left with 190 for the first half of the year, and then we hit the cap of 285 after that. Then we go into the household income figure, $47,750. Reduce it by the filing threshold, $20,300. We're left with $27,450. Multiply that by 1%, $275. Is line 10 more than 285? No. So we have to go back to that flat dollar amount worksheet. Back down here. And the reason I changed up this use case was for the first half of the year, the 1% of household income was greater. So we have the 275 figure for each month. Then the second half of the year, it flip-flopped. We went over to the 285 figure. Flat dollar amount was greater. Grand total 3360, and that goes up here on line 11. We divide that by 12, and the penalty is going to be 280. That's underneath the cap of 9,792, and 280 is our penalty. Verify that again on page 2 of the 1040, and then there's the 280. So that kind of shows you how the penalty can get kind of intricate depending on the scenario, and it gets done on a monthly basis. The greater of 1% of household income over the threshold or the flat dollar amount. Okay, now we're going to go through some premium tax credit use cases. We have use case number 4, basic credit scenario. Also from IRS publication 5187. We have Irvin, who is single with no dependents. He enrolled in a qualified health plan with an annual premium of $5,000. The applicable second lowest cost silver plan premium as shown on his form 1095A, $5,200. Irvin's 2014 household income is $28,725. Go back out to the product, home base, and we'll bring up number 4. And we'll drill into the 1095A that he would have gotten from the exchange. This section right here, part 2, indicates that Irvin had coverage for the full year, and consequently it turns off the penalty. And we get down to part 3, and as the example told us, we just need to punch in the annual total since it didn't vary on a monthly basis. So the premium is $5,000. The benchmark plan, premium for a second lowest cost silver plan, $5,200. Didn't receive any monthly advances. You can elect to defer all those until the end of the year. Go to the top here and click on the 8962 quick zoom. Family size is 1. Modified AGI or household income $28,725. That's 250% of the federal poverty line of $11,490. The annual contribution for health care is $2,312. And that goes into column C here. Column A, as we saw before, is $5,000. That's the annual premium. $5,200 is the second lowest cost silver plan. We subtract C from B, and we have $2,888. That's less than the premium, which would be the cap. So our premium tax credit is $2,888. Scan all the way down, and that's going to be our net premium tax credit. We didn't receive any upfront subsidies. And we go over to the 1040, down to the refundable credit section or payments. Net premium tax credit, $2,888. So that's a refundable credit that the taxpayer deserves. Okay, building on that scenario, we have use case number 5, another basic credit scenario. This one is from IRS publication 5187. We have Brandon Talbot, who is single, no dependents, and lives in Alabama. When he enrolled through the marketplace, Brandon was approved for advanced credit payments based on his projected 2014 household income of $39,095. The applicable figure for his household income is .095. Brandon enrolled in a qualified health plan. The applicable second lowest cost silver plan, $5,200. Brandon's Form 1095-A shows advanced credit payments of $1,486. Brandon's actual modified AGI for 2014 was $46,000, which is more than 400% of FPL, federal poverty line, for a family of one. Okay, we'll pull up number 5 here. And then we'll pull up the 1095-A once again. These are mandatory this year, so you will get one of these if your clients went to the exchange to get coverage. The 1095-Bs and Cs, indicating coverage from a different provider from the marketplace and from the employer as well. Those are optional, the 1095-B and C, so those may or may not come in this year. Okay, this section here shows that Brandon had coverage for the full year, so no penalty. And then we go down to the annual total, $5,200 for both the premiums and the second lowest cost silver plan. The advance payment of the premium tax credit, the yearly total is $1,486, as we said in the example. Quick zoom over to the 8962. One person in the household income $46,000. That represents 401% of the federal poverty line of $11,490. And consequently, he's not eligible to receive a credit. And you can see this coming up in real life situations where you project your income to be below the 400%, and you get your subsidies up front based on that, but then it turns out I'm over 400%. So let's see what happens here. You don't calculate the premium tax credit since you're not eligible. We punch in the annual advance payment of the premium tax credit, $1,486. We total down, and they need to pay it all back, line 25. Then it goes into this part 3. And if you're over 400% of FPL, there is no limitation on your repayment. So Brandon needs to pay back the full figure of $1,486. So we will go over to the 1040, page 2. And find out that the excess advance premium tax credit repayment comes in on line 46 and gets added to his tax. Okay, moving on. We have use case number 6, an advance credit scenario taken from the regulations. We have taxpayer E claims one dependent, F. E is eligible for government-sponsored minimum essential coverage. E enrolls F in a qualified health plan for 2014. The exchange for E's rating area projects E's 2014 household income to be $30,260. The annual premium for E's applicable benchmark plan, $5,200. E's monthly advance credit payment is $275. On August 1st, 2014, E loses his eligibility for government-sponsored minimum essential coverage. E enrolls in a qualified health plan that covers F for August through December. The annual premium for the applicable benchmark plan is now $10,000. The exchange computes E's monthly advance credit payments for the period September through December to be $675. E's household income for 2014 is $28,747. We'll go ahead and pull up number 6 here. Scroll over to the 1095A. Let's point out the B first. Let's say they got a B. We also have a miscellaneous screen here where they could enter in coverage. If they didn't get a B or a C, they can punch that into this screen here. We're saying they got a B, indicating coverage. So we have Edward. The dad had coverage January through July. And then we'll go to the 1095A and see what the exchange provides us. Okay, Edward had coverage to the exchange from 8/1/14 all the way to 12/31/14, and his daughter Felicia had coverage for the full year. Then we go down to the monthly premiums and the monthly premium for the second lowest cost silver plan. For January through July, it was $433, just covering the daughter. We have some rounding in July. And then for the balance of the year, that figure went up to $833 to cover the dad and the daughter. Monthly advances, $275 for January through July, and then $675 for the rest of the year. Okay, now we'll shoot over to the 8962 and total it all up. 2 people in the household. This 8962 takes the figures at year end and gives you the true premium tax credit. So two folks in the household income $28,747. That represents 185% of federal poverty line. The annual contribution for health care is $1,613. Divide that by 12 and we have $134. And that goes into column C for the full year. As we said earlier, the premiums and the second lowest cost silver plan, $433 per month, January through July, and then it bumped up to $833 for the rest of the year. We subtract column C from B, and we have $299 and $301. That's January through July, and then that bumps up to $699 for the balance of the year. It's underneath our cap of the premium amounts in column A. So our monthly premium tax credit, $299 and then $699 for the second half of the year. Monthly advances, as we said earlier, $275 January through July, and then $675 for the rest of the year. The grand totals, premium tax credit from column E, $5,592. Advance payments of the premium tax credit, $5,300. Subtract that out, and we have $292. And that's going to be our net premium tax credit. Go over to the 1040. Go down into the payment section, and there's our $292 net premium tax credit. Okay, now we'll go to use case number 7, a shared policy allocation, taken directly out of the regulations. Taxpayers V and W are married and have 2 dependents. In 2013, the exchange for the rating area where the family resides determines that their 2014 household income will be $76,000. V&W enroll in a qualified health plan for 2014. The premium for the applicable benchmark plan, $14,100. The exchange approves advance credit payments of $573 per month. V&W divorced on June 17, 2014, and obtained separate qualified health plans beginning July 1st, 2014. V enrolls based on a household income of $60,000 and a family size of 3. The premium for the applicable benchmark plan is $10,000. The exchange approves advance credit payments of $358 per month. Because V&W do not agree on an allocation, they must equally allocate the benchmark plan premium and the advance credit payments for the 6-month period, January through June, when they are married and enrolled in the same qualified health plan. Thus, V&W each are allocated $3,525 of the benchmark plan premium and $1,719 of the advance credit payments for January through June. V reports on his 2014 tax return $60,000 in household income and a family size of 3. A lot of facts I threw at you, but you can review those in your deck, but then we'll go and see the what the input and the output looks like within product. And I just took V's tax return here. I didn't do an example on W, but it would mirror similar results and inputs. Okay, so we'll go into number 7 here. This is Vincent's tax return. He got a 1095-A from the exchange. Vincent and the 2 kids, Arnold and Bonnie, have coverage for the full year. And then we're going to punch in the gross amounts for January through June. That's what the exchange would report out. So we have the monthly premiums and the second lowest cost silver plan, $1,175 per month. And then after the divorce, those went down to $833 for the month, July through December. And then the monthly advance payments, $573 for the first part of the year, and then they went down to $358 per month for the second half of the year. Then we need to make some additional entries. Shared policy allocation information smart worksheet. We have to indicate the former spouse's SSN, the beginning month and the ending month, and then 50%, which was the agreed upon percentage here. Because they're getting gross amounts on the 1095-A, and we need to split those. Go to the 8962. We find out that the household income for Vincent, $60,000. That represents 307% of FPL, federal poverty line. Turns out to be the annual contribution for health care, $5,700. Divide that by 12, $475. And we punch that into column C for the full year. And we come down and we look at Part 4. We have a 50% allocation for the premiums, second lowest cost silver, and the advance payments. So we have those net figures showing up in columns A, B, and F. We get $588 for the monthly premiums and the second lowest cost silver plan. That's half of the figure of the gross figures that we punched in. And then for the second half of the year, it's going to be $833 for each month. Monthly contributions, $475. We subtract column C from B. We get 113 for the first half of the year, and then it goes up to 358 underneath the cap in column A. So our monthly premium tax credits going to be 113 for the first half of the year, and then 358 after that. The advances, the net figure after reducing it by 50% is going to be 287 for the first half of the year, and then 358 for the second half of the year. The grand totals, premium tax credit, 2,828. Advances, 3,870. Nets out to be 1,042 of excess advance payments. It's underneath the repayment limitation of $1,250. Consequently, we need to pay back 1,042. Go to the 1040, top of page 2. There it is, excess advance premium tax credit repayment, 1,042. Okay, next we're going to go through some of the various exemption types. The first big subcategory in use case number 8 are marketplace granted exemptions. The following exemptions can only be granted by the marketplace and cannot be claimed on the tax return. We have members of certain religious sects, determined ineligible for Medicaid in a state that did not expand Medicaid coverage, hardship, coverage considered unaffordable based on projected income, unable to renew existing coverage, AmeriCorps coverage. However, marketplace granted exemptions do need to be reported on the return. So they're not physically being claimed on the return, but they're being reported on the return. Please refer to the 8965 instructions for the full set of exemptions. So to show you what these look like in product, I'm going to go to case number 8. And we're going to pull up the 8965. That's where you would enter those. And these are relatively easy. This is where you would have gone to the exchange to get your exemption, and they're going to issue you an exemption certificate number. So we're not physically claiming it on the return, we're just reporting it on the return. So we have Edward and Pamela, punch in their SSN, exemption certificate number, the month that they apply. Here it's going to be the full year. We scroll down to the penalty calculation, and we find that they're exempt for the full year and consequently no penalty. So that's the first type, and that gets reported on Part 1 of 8965. Okay, then there's another type here, use case number 9. That's where you have an exemption for income below the filing threshold. And here's a blurb right out of the instructions, or actually right on the form 8965. You're not required to file a tax return, and you do not wish to file a return. Your tax household is exempt from the shared responsibility payment, and you don't need to file a return or do anything else to claim the coverage exemption. Your gross income is less than your filing threshold, but you file a tax return for any reason, you're going to claim that in Part 2 on the 8965. We'll go into number 9 here. So we have wages of $20,000. Go back over to the 8965. Scroll down to Part 2. And 7A and 7B. Are you claiming an exemption because household income is below threshold? Yes. In this case, gross income is below that figure too. Yes. There's a little distinction between those definitions. You can find that in the 8965 instructions. So in this case, the household was exempt, and consequently no penalty. Gets shut off. Okay, our last scenario here is use case number 10. We have exemptions claimed on the return. You're going to use a pick list for most of these exemptions. The short coverage gap exemption is automated. That's where you have less than or equal to 2 months of no coverage or other exemptions. You can have only one of those types of gaps for the year. There's also there's a gap in coverage at the beginning of 2014. That's a different type of exemption. That's automated as well. I'm going to show you the first type here, the short coverage gap. So I go over to home base, and we pull up number 10. We'll go to that miscellaneous screen. And we'll say that Edward had coverage January through October. So he has a short coverage gap in November and December. Quick zoom over to the 8965. And we'll see, we want to punch in one for Pamela. We're saying for January through June, and we go to this pick list. Pick list has entries for the non-automated types of exemptions that you claim on the return. Coverage is considered unaffordable. Citizens living abroad. Healthcare sharing ministry. Indian tribe members. Incarceration, hardship, and limited Medicaid, TRICARE, and fiscal employers, fiscal year employers. So we would punch those in here. In this case, Pamela has type C for the first half of the year. We scroll down, and this is the 8965. We're showing that Edward gets a short coverage gap, which is code B for November and December. Pamela indicated a C type for the first half of the year. Continue on to the shared responsibility SMART worksheet. Edward had coverage for the first 10 months, and then he had a short coverage gap for the next 2 months. Pamela was exempt for the first 6 months, and then no coverage or exemptions for the last 6 months. Then we go down to the actual shared responsibility payment worksheet. Edward is either covered or exempt for the full year. Pamela has no coverage and no exemptions for the second half of the year. So she's going to get penalized for July through December. And that's what this does down here. Okay, so that's it for the use cases. I just wanted to share out this screen, and we did this in the earlier presentation as well, showing you the Intuit resources for accountants. We have a website with a lot of neat tools on it, and there's a link for it. We also have interactive guides for both IRS and ProSeries, and actually we just added one for ITO, Intuit Tax Online. The IRS website, very good at explaining the tax provisions of the healthcare law. You can pull up the 8965 instructions, which are very good in the 8962 as well. And there's some publications out there as well, like 5187. Some other places, healthcare.gov, Small Business Administration, and Department of Labor.